Mic check. Can you hear me?
Yeah, we can hear you.
What's my audio like? Do I need to switch devices? We're good?
Sounds good to me.
All right, cool. Bam, bam, bam. All right. Kind of jumped the gun a little bit because I was just ready to go. Give me one sec. Let me grab that notepad with the stuff I wanted to talk about. Okay, all good. All right, so bam. Let's give this a nice little introduction before I jump into yapping away. So I've had a lot of conversations lately, particularly questions, and they keep revolving around the same ideas, the same pointers. So I'm going to try to not create any sort of enlightenment video, but more create like a process so you can identify on your own which of these things I'm not doing, in my own opinion, properly. And then hopefully you can work on them and realize that trading isn't as bad as everybody makes it out to be. So I'm on, what's this? Oil. This is the last chart I used for my 1v1 on Saturday, I think. I don't trade oil. Let's go to what I actually trade. Maybe I could use this to add some real-time trading insights. EP. All right, so this is the last thing I had. I'm gonna get rid of all of it. And the analysis portion is going to come last. The first thing we're going to talk about is range creation theory. So I believe a big part of trading involves knowing where we are in terms of the range, not just the delivery. So we can try to decide, is the market in an efficient environment? Did we have price delivery on buy side and sell side? Or are we very efficient so we can now look for elements to leave the range, okay? That comes under an idea that I call range theory. It's just a broad range theory idea. There are many different ways to look at it. If you've been trading for any amount of time, then you should come across a million things. Maybe not fade into obscurity like some of the good stuff like maybe CLS hidden. So when you look at range creation theory or just range creation, there are a million things you can focus on. Most persons like to look at classical high to low, and then you fib that and you make all sort of stuff. And for the most part, if your trading revolves around things like OTE retracement, purely 50% retracement, breakout trading, then that makes perfect sense. And you should see some amount of success with that. But as you will inevitably come across failures just by looking at high to low, breakout, pullback, third soup, you start realizing that you're missing something from your trading. And it could be understanding or it could just be information. I'm going to argue that it's understanding and not information, because new information does not change who you are fundamentally. It should just change how you execute. Literally, it's not supposed to turn you from a very aggressive trader into somebody who's very disciplined, or from somebody who FOMOs into somebody who doesn't. Information is what you're going to use to create the rules on how to engage. I'm a simple man. I've, let's say, evolved from the idea of purely looking at high to low and start looking at an idea I call EO, which is just finding the last time we tried to get somewhere and closed beyond that point. Simple. So if we believe that the market was trying to reach above here, and we close beyond that point, game over. Nice and easy. If we're going to execute or look at the market through that lens, then on the daily chart, this is the start of a range, and then everything else to the left is irrelevant. So as far as our range goes, we'd be looking at the market starting to print here, creating a high, essentially your range high, trading down through this point here and creating another low of this definition here, trying to leave some amount of things for you to study. And that would make this your range low. So for all intents and purposes, if I'm looking at the daily chart through an EO perspective, then this is my EO range. If I'm bullish, I want to see a close above here. If I'm bearish, I want to see a close below there. Nice and simple. If the market has not yet traded to either of these points, then life can be as simple as looking at this, looking at that 50%, waiting for speed to come into this market after we've put an up candle or green candle right back at that blue line. So the market can be messy, choppy, consolidated until we get a green candle pass through this blue line. Okay, that would be here. Somebody's going to argue that this is a green candle, but this did not pass through that line. But especially the body. Body did not pass through that blue line. So this is when it happens. At this point in time, this market is now showing you that there is willingness to leave the discount portion of the range. As far as key levels would go, your key level would be that 50% level, and whatever technical structures you want to see here. So after November 28th is your trade idea, EO logic, trade above here. If you are the type of person who likes to play reversal, as I do, then projecting the range that you're trading is a big part of how you frame key levels. I don't want to run away with explaining like everything here. Just want to keep it generic to the things I want to talk about. So your range is created here. If you're looking for, let's say, how far up the high of the range could be if it expands through here, then you're going to take this measurement here, 3-bar high, 3-bar low. I'm just going to anchor it on at 50%. So that could give me one deviation above there. That would be that price. So for all intents and purposes, if I'm bearish or I'm looking for this market to run, this is my first target. Well, this is my second target. Depending on the size of the range, we could look at half deviations. And if I'm not mistaken, this is the full range. So this is in fact half deviation. One full deviation will be put in all the box on top of here. I personally don't like trading in all-time highs and all-time lows. So if you've noticed me being quiet last week, it's because we've traded above here, and I don't like the idea of external to external. I like external to internal. So I've been bearish, looking for the market to get back down here. It's not, so I'm not participating. Plain and simple. To amplify this discussion a little bit more, if I'm now looking for a range, since this would have been the target, just like when we wanted to see the market trade above here, the new target will be this high. We close through it here. That's the start of your new range. So we open. This is all buy side. Even though there are down candles, this is all buy side. Once the range starts, you get that open price, and we have not traded back through here, it's essentially a one-sided market. Simple. So nothing to really get crazy over. One-sided market. So at the very least, if we're going to rebalance this delivery, my expectation would be this little bit of, let's call it imbalance between right here. I would want to see something print here that confirms direction. So if we come down, we put a down candle, I want to see them take its high, retrace, and then new highs. If we are bearish, then I want to see us close through here aggressively, ideally 2 down days. I don't want to see it retrace to something inside here, maybe whatever, something should be clear and obvious, and then lower prices. At that point, I'd be looking for 2 downside targets. Target number 1, open of the old range. Target number 2, low of the old range. And I guess we could throw 50% of the old range in there, but whatever. The fact is, once we are in this environment now that's one-sided, this little area here becomes my draw. Plain and simple, because of the definition. So one definition for how you create ranges, 2 examples. Hopefully that's clear enough. Second point, reading deliveries. We talked about a little bit of that in that conversation. Essentially, to me, reading a delivery means if I can identify with rules where a delivery starts, I should be able to read what the market has been doing since the start of this delivery. You go back to here. This blue line here is the last time we started the delivery. One-sided market. Just like this now, we open, it's one-sided market. If it's one-sided market, it means since the open to wherever the market's traded at the moment, that's inefficient. So at the close of this candle, from the open to here, inefficient. Obvious, that's obvious. This day, inefficiency. This day, all of this is inefficiency. It's inefficient until we trade through here. When this day prints, everything that only includes a down candle body since the start of this delivery is one-sided, like this. So when I was explaining earlier and I said, once we have an up candle body passing through this blue line, I'm expecting speed. It's because once this range is made efficient, one-sided, efficient, one-sided, efficient, I now believe that there's nothing left inside that efficient range for the market to trade to, which means we should seek external liquidity. So after here, if it's bearish, it's going to break down, turning this into an order block, lower prices. Or it's going to break higher, turning this into a bullish order block, this into a breaker, this into your buy side liquidity. Simple. So with that in mind, you can track when the delivery starts, where it should draw to, what you want to see there to make a decision, then you make a decision. The more you do this, the more you should have things like this in your journal. This is one delivery. And then off the bat, it should be something that everybody knows about or everybody's seen before. We have a low, we raid that low, comes back inside the range and it push. If you are more technical, then you'll see a low, housing sell side, the market running through that with an expansion, back to the start of the expansion, printing bullish arrays, running sell side, CSD, gone. You could see FVG in a stop point leg. You could see close above the FVG in a stop point leg. CSD, gone. So there's a million different things that you can see here when you apply rules to how you look at the market, and then just trust the repeating elements of it. Simple. Tracking imbalances, pretty much what I just said. if we look at bodies housing the bulk of the trading, quote unquote, volume, then anywhere there's no bodies, then there's a lack of volume, air quotes. So when we go up candle, we print a high. Between the high and the start of the delivery, anywhere there's no down candle bodies, since this went higher, it's inefficient. So tracking deliveries in this case would be from the open here, that body. That's an imbalance. Market comes down, fills in a portion of it. It fills in another portion of it. It fills in another portion of it until eventually we fill in all of it. And then it creates new imbalance. Tracking imbalances will give you a level of confidence, but it can be a little bit misleading sometimes when you only want imbalances. But if you can see them, then you should be able to read a basic structure, higher highs, higher lows around it, and then make a decision. Push through. Once the market comes back and fills in all of this here, then the range, since here to here, is now imbalanced, or balanced, sorry. Which is why, just looking at this, first thing I said was, once we trade through here with a green candle, because I'm tracking the imbalance since the start of delivery. Eventually, you won't need to mark it out, but for journaling purposes, it's always good to just mark them out, as many as you can, any time frame. Look for the patterns that repeat. Tell yourself you're only going to trade the ones that repeat. Life is simple. Framing liquidity now becomes a little bit easier. Based on the range, it all starts with the range. Based on the range you're trading and where we are in the range, I can see 3-bar highs, which will house external liquidity, or since the start of the delivery, everything inside here, which fits the definition of a failure swing, becomes liquidity. What does that mean? We start here, we push higher, 2 higher lows, both failure swings because they didn't take any liquidity. We had a run on a failure swing here, then a push up. The liquidity is not here, in my humble opinion. Failure swing. We take that, it's just reaching for the liquidity here. It's not taking liquidity here and then, no, it's just reaching lower. Higher lows, the liquidity is right here because this is higher. Always a failure swing. Whenever there's a push that fails to make a higher high or make a lower low, that failure becomes a liquidity. Trade through, liquidity, breakaway gap. This is a dealing range inside here. Buy side, sell side, retrace, looking for an expansion here. And classical terms, you just want to see a breakaway gap. A FEG in an environment where the draw is clear becomes a breakaway gap based on the structure. That's a little bit crude, but just that you'll see it on your own. So all the lower highs inside here as we're trading down, once you get a 3-bar daily low, you're interested in those failure swings. This is a failure swing. This is not, because we took here. This is a failure swing. No 3-bar high, no 3-bar low, 3-bar low here. So when this candle prints, you're not looking at taking this high as liquidity or taking this high as liquidity on this day and then that's it. You're looking at this and this as liquidity. So you come into the market on this day, you're looking for higher to take liquidity. That's it. You're bullish, you're bullish, you're bullish, you're bullish. Liquidity taken here first. Retracements are possible. Put your fib on if you're a fib person. Identify where it should go to, identify your failure swings. That's where you start your setups. Next draw here, and if it's going to leave the range high. Straight through here, FEG being printed in an environment where the draw is clear, becomes a breakaway gap. No fill, it runs, there you go. So for long-term thinking, going into like maybe January, this breakaway gap here is going to set the stage for, do we get lower prices or not? So while we can see the range, we could look at any high volatility days that pushes the market beyond this range. And I'm specifically referring to the range here. Any high volatility day that pushed the market below this low, start thinking about, do we fill this in or not? Filled it in, retracement, lower prices. Ideally, you'd not want to see them retrace back above 50%. So to make a run below here with a body beautiful to expect this, I'd want to see them finish, putting down candles here and putting big wicks on top of the down candles to show that we've retraced as well as filled it. So we have filled the imbalance with bodies, and then the wicks on the top shows that retracement is done. So then if buy side is taken and it's retracing, you look for sell side and an expansion. And that's going to suggest big body down candles trading through here. You look at this for context. Do we get lower prices? You look at this as the draw. And outside of that, it's just whatever else narrative you could put together. Why that daily FEG and not the one formed at the high? Here, if you're asking why this is not being used as a breakaway gap, where this here? Oh, fair enough. So my rules for trading are simply enough that anybody can follow. If the market is running away, I believe the first FEG formed should be considered a breakaway gap. The second one is the one you expect the market to retrace to. Okay. If this market was one-sided, or let's not use one-sided. Let's say the buy side draw has not yet been met, and this market was just printing green candles, green candles, green candles. Then I'm looking at the push here, the first FEG, which by definition would be this one. I like this one because it was printed after the liquidity was taken. So while this is here, it's inside where the liquidity is. So arguably you could use this as a breakaway gap, but this is the one that I don't want to see filled because it's bigger and more energetic. So this is a FEG, yes, but if you look at the swing from here to here, it's not the second FEG, it's not the first FEG. It holds very little meaning to me. In context of trading above all-time highs, printing a new range, this is an imbalance. I don't see this as fair value to retrace down and go higher, because fair value must mean like ideal price for transactions. So if you look at this, and yes, it fits the definition of a fair value gap, but if you look at it and you're expecting something like it's going to hit here and then go higher, then that would mean that you are expecting Nasdaq to trade much, much higher. I try to not frame bias around that, especially in all-time highs territory. Don't let the technicals guide me or anything fundamental that jumps out. At the moment, job numbers, Trump going back to office, Powell, time of the year, those are the only things I would look at as fundamentals here. Santa Rally made a new high, some amount of retracement. I'm not going to call a top and say, hey, I'm instead going to read, when it gets here, what does it print there that I can use to say another high is coming? But without bias, without knowing anything that's happening in the market, purely technical perspective, we have inefficiencies inside here. And this is the most obvious sell side draw that I'd be looking for the market to reach for. It's below that. High volatility days can drive it here and then it rejects. High volatility days can drive it to get a close below here and then we break down. I would look for somewhere February-ish. If we don't get anything significant, I don't want to see somewhere February-ish be trading down here. And then if we're printing bullish signatures down here, then I want to see a new high. That would be easy to trade. Big range, sweep the sell side liquidity below it, higher high. All right, because once Trump hits office, I'm expecting the stock market to go crazy. His policies favor bullish Nasdaq at the moment, unless something comes out like war or whatever. But for now, bullish first 2 quarters of 2025 is what I'm thinking about. But the next thing was on the list was planning. How do you plan for setups? Now, ignoring the time frame, if I had the start of my delivery there framed, it would be very easy for me to plan a long trade or a short trade here. Easy. First thing is, this is the drawn liquidity for the downside. I'm going to take off this here. See if I can go H1 for a second. I have not been going H1 for some time now. Let's say this is the start of my delivery. It's also the H1 mitigation price, nonetheless. We trade up. On lower time frames, I can see how there's a level of efficiency right here. So we had down candles and up candles went through, pretty much the same as the daily chart in reverse. If you look at it carefully, delivery starts, we went higher. So this is all one-sided. Trades through. When a green candle passes through here, like it did here, expect speed, the market comes down, prints order block, trades to the high, retrace. And then again, if you're looking at like projections, it would be like here. If you're wondering how I picked this, you have your range. This is efficient. So on an H1 chart, the imbalance would be between the down candles here. Right there. On an H1 chart, that's the imbalance you're looking for to get filled. So you can track it. Anytime a down candle body hits inside there, you adjust. You keep going until you get another down candle body that's lower. And that's what gives me confidence. If you ever hear me talk about price trading to a particular level with confidence, that's why. So this was the last time we framed something bullish inside this range. I didn't get the run. I didn't get all of this, and some of the days were just really messy. So you remember the chart from way back when I shared it, and some of these should be familiar. Bullish order block here, all that good stuff. The run above here, I believe, that we wanted from inside here, and then it tanked, and then blah, 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 whatever. But yeah, this is the imbalance you'll be looking for to get filled. You're trading through. It gets filled with a body right there, 7 p.m. Thursday. So the open of the next candle after 7 p.m. there, that starts your delivery. And you can see the reactions and all that good stuff. Trading down, creating the lower the range. Last time we closed lower was maybe about here, but irrelevant. So for planning, you could always see the imbalances when they jump out. I like to look at imbalances paired with structure. If you have a big imbalance here and we have lower highs, when the market is trading up, you don't expect it to stop at the lower highs. You expect it to trade through the imbalance. If we put bodies through the imbalance, that's suggesting higher prices. If we can't put bodies through the imbalance, then expect lower prices. This wick traded lower. I believe I was short inside here. Scalping, traded up. I messed up inside here. I can say this now because I didn't get confirmation on the H1. I was merely expecting it, and it was just doing this, if you remember. And then at 9 o'clock every morning would just be wild. Nonetheless, once we trade and the H1 is there, you start looking for buy side runs. Trades up, internal buy side, look for lower prices, short-term lower prices, and use the same definition. Start of the expansion, you're looking for the biggest FEG. Once you can see it, big FEG here, that's going to be your breakaway gap or act as your breakaway gap. No fill means higher prices. Rejecting, higher prices. So from an H1 perspective, this is your range. And if you want to track it on H1 as well, open, one-sided, comes back down, hits it, runs away. Lots of 3-bar highs inside here. This is the first one. I like using the first one because in real time, that's what I would see. Trades down, hits 50%, starts to move higher. Bam, like this. I never use the first to run above a 3-bar high to frame a new range because I'm always expecting the first to run above a high to be stop run because breakouts fail. Run above, high, goes above, FEG is going to print right there, that high, and that FEG should be your breakaway gap. Those who know what I'm talking about here. Nice little illustration. So breakaway gap. So on an H1 chart, right? The projection level is still a little bit higher. If we fill this with an H1 body right here, I'm going to be bearish. I'm likely not going to participate a lot this week. I don't know what the calendar looks like, if I'm being honest. Just put that in there. So nothing until Wednesday. So generally when you have high impact news coming out on Wednesday, Monday and Tuesday can either be one-sided or consolidated, but they never break down. And the rule of thumb is to not expect Monday to make the high of the week. So right now, the high of Monday is here. I would not expect this to be the high of the week. So planning a trade for this week, I'm going to expect to go short above Monday's high. Maybe it's going to be a Tuesday high of the week, and then Wednesday just really pushes. We don't know. We really don't care. It's all about not the market following your rules, but you following your rules. I don't expect Mondays to create major swing highs. I never do. And if they print, I don't like them. So if you're in the group, or even if you've heard me talk about it loosely, this daily high here was Monday. Now, I did not say this, but if you know me, whenever we have daily highs being formed, I never look at the highest one as a drawn liquidity. It's always the failure swings for me. If you remember when I framed this, I specifically said buy side liquidity is above here. That's because this is a Monday. My rule for myself, to keep myself in check and sane, I don't trust Mondays creating major swing points. It does not make any sense to me. So right now, I don't expect this Monday to be the high of the week. If for any reason we get Monday, Tuesday trading lower, I want Wednesday above here for a short, or it's just going to be continuous bullishness. But I don't want to get too passionate about that. Just simple rule for Kishan: Mondays do not create the high of the week. If they do, something is going on. It's a trap, it's a trick, it's whatever. Yeah. Last one on the list was journaling. Journaling is pretty easy, pretty straightforward. Depending on where you are in your development, journaling, like these, just identify the level, put a note there so you know why you're looking at that level. So if I was still back in 2019, 2020, lies, I didn't know this in 2020, maybe 2021, 2022, I'd have a note here that says Mondays don't create a high of the week. Simple, just like that. And then every day, including today going forward, I'd have my M5. Don't remember what this blue line was for, so I'll not pay attention to it that much. Every day I'd be looking for what does the M5 fractal look like as we trade towards here. Do we have a Monday low or a Monday ONS low? Equities open, sweeping that, equities open, coming back to 50%. Then we take that. Do we have Tuesday taking Monday's low in London at equities open? Something that shows me whenever higher time frame liquidity is on the menu, this is how the lower time frame can print. Just screenshot the day. So if you are still trading on an overnight session, we're gonna find 4 a.m. And for simplicity, I'm gonna stop it at 8 o'clock. There's your range. Nice and easy. So now you have liquidity just above overnight session high. This is a popular bullish profile. So for trading today, I'm actually going to track this if I stay home. Equities open. I want to see where the open is. I'm not going to force it to be somewhere. I want to see if we wick below the low versus close below the low. I want to see, put an element of inefficiency. This portion of overnight session is very efficient. Okay, so let's put a little gem in this. One-sided overnight sessions generally automatically point to where the imbalance is. If you've been listening to what we said about how to identify the imbalance, one-sided delivery, right? So we know, just push this over to the start of the box for visual purposes. We know everything above here is one-sided, and it doesn't take much to see that it's all down candles, okay? There's a FEG right here. This FEG is currently acting like a breakaway gap. It's currently acting like a breakaway gap. No fill. So the best bullish setups are going to come once we close above here. Now the setup, I don't know what the setup is going to be. The setup could be a fast run that includes only green candles. So we close above here, then we wick below, and then it's gone. It could be one big green candle through here, making that beautiful BPR logic, and then it runs. Or it could be wick above here, trades back down, creating some type of dealing range logic, then it goes. As we are right now, look at the efficient portion of this range and how we're just sat at 50%. This sitting at 50% here is suggesting two things to me: build up of sell side liquidity or no willingness to go lower. So if I'm aggressive, I'm already looking for a trade. If I'm not, I'm looking for something to confirm my direction. That could be close above here, a trade above here, followed by a retracement to maybe OTE of wherever the eye is. So if we have something like it wicks above here, I put my fib from that high to here, eyeballing OTE somewhere around that. So that could simply be what it is. Or it could be one of those equities open that's wild, and we start wicking lower, or it just pushes lower first, or whatever. I would look at two things. In efficient price ranges, aka consolidations, ICT gave us this beautiful, beautiful idea that says the PD array, or the key level you pay attention to in consolidations, is equilibrium. Simple. The market's in a consolidated environment, equilibrium is king. I don't want to see either failure to close below here when it starts to wick, or if it wicks below, do we snap back and close above 50? Those would be the things that would tell me, yes, don't even start a perfect inch, just go, just buy. buy the next candle, something like that. All the narrative that we should see, if this is going to trade higher, is going to print here. So if you realize that it closes below, then it's just wicking. Don't have to enter. Allow it to wick. Then if it starts breaking down, then you start stalking up your setup, and you can use projections of the efficient range to target something lower. Then that's it. Then it could be one of those days that runs and we don't get any type of reversals until sometime after 10 o'clock. Simple. Or it's nice and easy and bullish and you just bam, 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 and it goes. Okay. As usual, we never want to make these calls too long. You know, the message gets lost. But yeah. Let me see what's in the chat. 2 bags. They could be 2 bags, but ideally no. Ideally, I just want the more energetic one to be respected. Which of your range on each one are good trade opportunities? Probably. Could you go to EO range? Yeah, you could track EO on LTF. Once you have the EO range, you could track efficiency. Kind of like how we move from the daily there to the H1. And see this chart by Jason. Bam. Bam, 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 bam. This looks like cycles. Looks very cyclical. But we'll see. When considering an imbalance, considering imbalance is an imbalance potentially, you consider body to body or wick to wick. So the imbalance is defined by the bodies to the bodies. But when I'm looking at the trading ranges, high to low, always preferred. Body to body for imbalances. So if we open and we have, so let's say equity is open, let's say you're tracking 30-minute imbalances after equity is open. You'd be on a 30-minute chart, you're marking a 9:30 open, first 30-minute candle body, the body is your imbalance. And you start tracking. I personally don't like that, but yeah. Chicago time and daylight savings and keep it. So my time is set to UTC5 all year round. The only accommodation I make is I know equities open is at 9:30 this time of the year, and earlier it's 8:30. So that's the only change I'll make. So if you notice, most times I'll start posting around about 8 o'clock because I'm used to waking up at 8 o'clock. My body is conditioned to that. But I know equities open is 9:30, so I will sit patiently and wait versus, yeah. There we go. So as an aggressive trader, this is something that I would be considering simply because the low is already in, 50% is being respected. The risk on this looks very, very small. I'm not telling you to go and buy this. I'm just being human. I would look at least this for a scalp. That's 80, roughly about 20 points. And then if that scenario plays out where equities open is just one-sided, then I'd get a really good trade, but it wouldn't have a lot of size on it because I'm not crazy to put a lot of size before equities open. I don't care who does it, and I don't care how many times it works out. It doesn't fit my comfort level. I'm going to micromanage it. And yeah. Wednesday is always UTC -5. Yep. In general, what information you think or expect one to take away from weekend? So the simple response is you will journal the things that you consider important based on where you are. If you've just started trading, you're going to be a PDRA fanatic. You're going to mark every single FEG, you're going to mark a lot of stuff when you just start. Madness, unnecessary, completely unnecessary for growth. But what it will show you is that marking all these things is not helping me become a better trader. So I'm going to stop. That's what it did to me. Now, I'm very big on deliveries. So being big on deliveries mean when I can identify a drawn liquidity and I can see the price action, I can anticipate what the swing should look like. Right? So this is not drawn to run below here, but I explained what can happen at equities open. I don't know because I'm not in the market as yet, and I can frame what it should look like. What it does before here really doesn't bother me that much. So if I'm journaling today, and I will, my journal for today will include what price swing gets taken after 9:30. Ideally, in a perfect world, equities open does a Judas. When equities open, just open and it just runs, it's usually not beautiful, or it's not a sustainable practice. So you have like it opens and then it's just one heavy H1 candle. It's setting up something for 2-3 days later to come back to. Like it's just normal. Normal stuff is equities open doing a run on liquidity inside here. And while this is beautiful in terms of a 3-bar low, it's sitting right at that 50% level. So I would not feel like, oh my God, I'm so wrong if it took this low. Or if I had an actual trade on and it stopped me out here, I wouldn't be afraid to look for another entry because equities open generally reaches for this. So devil's advocate, I am going to leave this and then put the screenshot on. Send the screenshot in the group. Whatever the range is here going into equities open, from this low to whatever the high is, it's currently this high. One of the best setups that can print is this taking that low. But again, keep in mind that 50% is here. So it could just want to do this and play out this trade. But if I was in the mood to be aggressive, is at 20 points. 68, roughly about 20 points. That idea, the one that comes all the way down here to print a order block, I'd be less interested in that because of the efficiency of this range. That 50% level would be ideally what I want to look at. So we will see in about 33 minutes when I check back. So now, if you have any questions, it would be a nice time to, when we realize markets does not have to follow rules, what do you advise a beginner that balance analysis for sure? I like this. It's been a while since somebody asked a question like this. So depending on where you learn trading from, or wherever your mentor is to get you, got you into trading, they will emphasize some things about the market will do this, and once the market does that, you do that. It makes you very reactionary, and I don't think traders who trade like that have the confidence of other traders, simply because they have no narrative as to why it should do something. It's more of a, oh, the market is always doing 1, 2, 3, 1, 2, 3, 1, 2, 3. Or if there's a process in the market, it's always going to be 1, 2, 3, 1, 2, 3. I'm very curious. So I label things and I define things to make them understandable to me. And one thing I do is I look at not just the fact that I think this is the drawn liquidity and it got there. I don't look at that. I look at how it printed. Because if I can see how it printed, then I can create a process for myself. One that could say, allow the drawn liquidity to be printed at Monday's high. Allow an imbalance to be printed. Allow a bearish order block. Allow something to be printed at the high to push the market lower. Then allow for an efficient range. Allow for volatility to be injected in the market and watch to see if that volatility swept opposing liquidity or confirmed direction. Once one of those things are done, the entry is going to print. If I trust that much that entry will print, then the rest becomes easy. So the analyst is going to be the guy who wants to look at everything technical. Oh, there's an order block. Oh, there's a FEG. Oh, there's a FEG. Oh, there's no. For me, it's a process. 1, 2, 3, 4. If this is 1 and this is 2, 3 would be either taken here or taken here. As you start journaling those processes, you will come up with your own idea of what an aggressive trade looks like. This is why I'm saying this is an aggressive trade. You're going to see instances where it was okay to break a rule and enter early here, or I'm glad I didn't break a rule and enter early. Those are the things you must see as you grow. You can't be 5-6 years in trading and you don't know when you can put more than 1% in the market. You can't be 5 years in and you don't know this is a trade I'm going to lose. You can't be 5 years in and you don't know. Right now, I'm so attached to this trade idea and it's been wrong. If I don't step away, this small loss is going to be very big because I'm going to try again. Those are the things that separate real traders from persons who just post and talk about stuff for fun. Real trading means know yourself, know thyself. It's a real thing. I know if I don't get my full 8 hours sleep and I wake up and the first thing I do is head to my desk, there's a 85% possibility that my first trade for the day is going to be a loser. And I know that. I know that if I had a big dinner, like a big dinner and I didn't get much movement, no walking in the night, or I wake up and I don't do any type of physical activity, I know I'm going to be sloppy at my analysis. I know that about myself. So my rules are to stop me from acting like a fool in the market and then losing money. That part of the analyst versus the trader, it has to happen so you can say to yourself, I took 10 trades, every single one of them was beautiful. I took 10 trades. These two were very aggressive. And even though it was a winner, I wasn't comfortable watching it play out. I kept thinking that maybe I'm going to get stopped out. Maybe I'm going to get stopped out. Or it's running and it's not going beyond 15 points. It's just 15 points and 8 points and 15 points and 8 points. And I kept wondering, do I cut or not? Those are the things you have to journal your own experience. Stop trying to journal everything about the market. It's impossible. The market does a few things like create imbalances, fill them, generate liquidity, run them. That's all. That's all it does. But it does them in different ways. For me, I call them profiles. Profiles vary. You have profiles that are just big imbalances, and 50% of the imbalance is just like a brick wall. We can't get back through it. Like here, this is a BPR on top of a efficient range. This can be a brick wall and we never get back above here, which is why my confirmation is either it sweeps here, prints a bullish setup and runs, or it gets here and shows me what's up. I'm not comfortable knowing that these are the levels that I should pay attention to, or these are the things that are going to make me lose money. In any market, identify a range. The other thing about identifying ranges is using timed ranges. Do you have any filters that you haven't shared that we can study to help entries and direction? Other than trigger candles, which is a lot. There are a lot of things I can show you and we can talk about. Okay. Let me do this. Generally, this is something I shared about 1 to 2 years ago when we had a PIP group. If you weren't around that time, PIP, Implement Performance Improvement Plan. The persons who knew how to trade but couldn't take that information on and put it into a process, I created a pip group to target specific processes, right? So if you were around there, beautiful. If you weren't, then too bad you missed it, right? Market reversals are generally easy to see. The first one that I saw and I loved was when the market did this. At a key level, we had 2 down candles, followed by an up candle. That's a profile I like to see. What I like about this is if we have 2 down candles and this candle closes through the open. Now I'll make that a little bit more beautiful for the persons that have been with me for some time. I'm going to draw this using the annotate function. If I have a down candle, I'm trying to draw the wick on this guy, but it won't allow me. There's the wick. There's the wick. Attention to the details. Then we have here let's put the wick somewhere. Let's put this here. I think I know what I'm doing wrong. So that's the wick, right? And then we have, here. It doesn't need to close through this high or this, but it needs to close through this open price right here. Whenever that happens, I personally like the idea of getting trades like this. That's a fractal for me. 2 down candles, 1 up candle that closes through right here. I'm trying to draw it, won't let me. Why? Sometimes I wonder. Like that. Simple. And then the reverse for bear setups. We have 2 up candles. Same logic here. This is a logic, it's not a drawing. Down candle goes and it closes through. There. So we have 2 down candles here. When it closes through right here, that would be a buy. This is 4 down candles, but starts here. Here it is. It closes through here. Same idea. 2 down candles here. It closes through here. Same idea. I have 2 up candles here. Pay attention. This is not fitting the definition. I'm smiling because I know somebody is not going to get my meaning and somebody is. 2 up candles here. When it closes through the open price of this right here, you're shorting that. 2 up candles here, goes down and it comes back. You'd be looking to go short right inside here. There. See? For futures handle, that was his name. Let me just check again. I trust that you have been introduced to the fail expansion logic. If you have, this will make sense. If you haven't, then it's all recorded. So same idea here. This does not fit the logic. This does. it trades and it closes through. I'm buying it right there. And then whatever 77, 87, because the draw on liquidity is so close. That's what I'd be looking for. Probably got stopped at break even. But yeah. Simple mechanical logic. I trust that it's going to be useful. I'll end this one here to not make it a long one. If at 9:30 in the next 21 minutes, I am still around, it's a Monday, I will do another call. We could watch the price action live and I'll trade it. So you can see whether or not I follow my own rules. But this, yeah, this is 100% going on YouTube, guys. Yeah. So the gem of the call is this. This is the gem of the call right here. I trust that you will utilize it. It's for all the persons who I owe you some gems. Don't think I forgot. Don't think I forgot. But yeah, do enjoy the rest of your day and see you in about 20 minutes if time allows. Peace. Like and subscribe.